Now, I'm supposed to read this statement to you all here, but why don't you just read it on your own time, and I'll just tell you what the fuck's going on here. I've been here all night, meeting with the executive committee. And the decision has been made to unwind a considerable portion of the firm's holdings in several key asset classes. The crux of it is, in the firm's thinking, the party's over as of this morning.
If you have browsed Wall Street Bets or used the Robinhood app long enough, you will have likely heard the term margin, a word that brings with it a lot of confusion as the details surrounding it are shrouded in complex terminology. In today's video, we break down what margin really is, if you should be using it, and what its pros and cons are. If we specifically focus on Robinhood, which is what the vast majority of my audience uses as their primary trading platform, margin accounts are extremely popular and for good reason. If you head over to the Robinhood help page, it explains exactly why. Robinhood essentially offers 3 different account types. When you sign up for a new account, you get what's called a Robinhood Instant account, which in fact is a margin account by default. This lets you have instant deposits and extended trading hours. The main reason why the company essentially puts you into this account category automatically is because you don't have to wait days for your deposits to clear. You can actually begin buying and selling stocks right away with this instant account. This is a massive bonus for impatient users who want to jump right into the game. When you go and click that deposit button, that money that you just moved from your bank account to the app doesn't actually hit Robinhood for a couple of days. So instead of having you wait, Robinhood will actually allow you to borrow a set amount of money, usually equivalent to your deposit, to use immediately. This way you're not stuck waiting and they can feed your gambling addiction without having you lose interest. Margin at the end of the day is defined as borrowing money to buy stocks. Although this version of borrowing money doesn't necessarily increase or decrease your risk, it simply allows for quicker deposits and higher customer retention, it's still technically considered margin trading. Once we begin talking about Robinhood Gold, you will see the classic definition of trading on margin and just how dangerous this can really be. But before that, we need to talk about the third type of account that most users don't even know about: cash accounts. If Robinhood didn't offer instant accounts by default and instead forced you to use a cash-only account with absolutely no borrowing, you would be inconvenienced by various rules and regulations that accompany cash accounts. For an example, not only would you have to wait a couple of days for your deposits to clear, but when you sell a stock in a cash account, that cash you receive is not instantly settled. You have to wait a couple of days for the proceeds of the sale to be available to you as buying power. For example, if I have $1,000 in a cash account and buy $500 worth of stocks and sell them the next day for $500, you won't have $1,000 to spend. You will have the $500, which was already sitting there as cash before the trade, while the remaining $500 that you just sold off won't show up as available until about 2 to 3 days later. This is because Robinhood needs to settle that trade. In a margin account, you don't wait for the settlement. Robinhood will actually just borrow you the money from the sale for free, while it settles 2 to 3 days later. You won't even realize they're doing this, as it's all done in the background. Due to these reasons, not many people use cash accounts, especially on Robinhood, where frequent trading is extremely popular. People are eager to get in and out of trades very quickly, and having your buying power diminished as you wait for settlement is not acceptable to many users.
But I gotta say, if I learned anything, it's that gambling is not your problem.
It's not.
Not even close. I don't know how to say this without sounding a little rude, but you're a lemon, Leon. Like a bad car, there is something inherently defective in you. And you, and you, and me, and all of us in this room. You see, most gamblers, when they go to gamble, they go to win. When we go to gamble, we go to lose.
Finally, we have our third account type, Robinhood Gold. While many people don't realize it, Robinhood Gold is what is equivalent to a casino on steroids. This account type you pay for, and it comes with a load of features that I won't be going over in this video. I'm just going to talk about the margin access this account type gives you, probably its most important and dangerous feature. Gold accounts give you access to borrow a set amount of money from Robinhood. In return, Robinhood charges you a $5 monthly fee, plus 5% interest on any amount borrowed over $1,000. So why would anyone use this? Well, let me give you a positive example. Let's say 1 year ago you bought Apple stock, which was trading for $206 a share. Your Robinhood account had $10,000 in it, and with Robinhood Gold, you were allowed to borrow $30,000 on top as margin. This gives you a total buying power of $40,000. With that money, you bought 194 shares of Apple. You patiently wait 1 year, and you sell today where Apple is selling for $503 a share. This will result in a $57,669 profit. We then subtract interest and margin fees away from that amount, and we get a grand total profit of $56,100. That's an incredible 561% return on our original $10,000 investment. Now, if we compare that to using cash instead, we would have earned a nice $14,700 profit, which is great, but not even close to the margin earnings. Margin is really nice when we look at it through a positive lens, but the alternative yields horrific results. In that same scenario, if Apple had dipped, our losses would have been accelerated, and to make matters worse, we would have been margin called, a scenario where you're forced out of your position with extreme losses in order to pay back Robinhood. Margin calls happen when the value of the underlying stocks in your account fall, causing the account's value to dip below your maintenance margin. If you get a margin call, you need to bring your account value back up to your minimum margin maintenance, or you risk Robinhood having to liquidate your positions to meet the margin call. So in another scenario, if Apple had experienced a 33% loss, you would have been likely forced to sell everything, experiencing an almost total loss. You have to understand that if you're borrowing $30,000 and using $10,000 of your own money and Apple goes on a 33% fall, your total losses amount to $13,600. So not only would Robinhood take your $10,000 you invested, but they would send you a bill for $3,600 plus fees because you literally lost more money than you have in your account. This is why this strategy is extremely dangerous. Think of it as walking into a casino with $100 and for nearly $0 they let you borrow 5x that amount with a click of a button. A dangerous feature for many young people early in their trading careers. If I was making a recommendation to any young investor out there, I would say please use a cash account. It will force you to think about your trades and puts you into a long-term mindset that has proven over and over again to be more effective and profitable. If you are day trading on Robinhood with margin, you are essentially gambling on steroids. There is no point in borrowing money you don't have on speculative assets that you likely know very little about. You probably have more insight betting your favorite team than you do randomly placing your hard-earned check on a random call option for AMD. Please use your head and don't get caught up into losing life-changing amounts of money that dig you further into depression, debt, and problems. Please hit that subscriber button if you enjoyed, and make sure you comment below with your thoughts on Robinhood investing.